I am a chartered accountant and qualified a number of years ago, and then went into financial services, into investment banking. And I really thought that I understood cash flow. But what I realized is I understood finance and maybe on a corporate level, and I didn't understand cash flow at all. Because after investment banking, I left to start my first venture, was able to raise a bit of money from family and friends, and thinking I was a chartered accountant who knew what business was all about. I very quickly realized that wasn't the case. And I made two sort of major mistakes right up front, where I overinvested in the platform that we were developing. I built an e-commerce business up front and completely overinvested into stock for this platform that I thought would sell like hotcakes, which wasn't actually the case. It took a bit of time. So there I was, at about 29 years of age. I'd spent all this money that I'd raised, and really the business hadn't even got going. And that was my first introduction to what cash flow is all about. And if you don't have cash, you don't have a business. And what that really resulted in was, for the next 18 months or so, as the business started to gain momentum and grow, but I wasn't going to go back to family and friends to raise capital. I wanted to make it succeed on my own, and really it put me in a position where I couldn't pay myself a salary for about 18 months. And all that money was going back into the business. Basically, from the mistakes I had made, that money was being invested into stock, helping to grow the business. At that time, it really gave me the idea for what would in future become Lululemon when I finished with that particular venture. But those were the hard lessons that I learned up front about cash flow. You need cash to survive. If you don't, you're not going to be able to pay yourself or your employees a salary, and you'll be out of business pretty quickly.
Thanks, Trev. That certainly sounds like it was the school of hard yards. So hopefully we can share some gems today and help people avoid such lessons. In today's presentation, we're going to tackle the topic of cash flow and its management. We'll start at a high level, just discussing it as a concept, and then we'll dive into a bit of detail around how we think about solving it, both from business tactics, but also from sort of a funding perspective. Right. So cash flow management, and what's all the fuss? I mean, like Trevor mentioned, it's obviously, if you haven't got cash, you haven't really got a business. And I think we've you commonly hear businesses often fail. And I think people often think that a business failed because they're losing money, but actually the reality is it's often because they actually just run out of money. They actually just run out of the cash to really keep the business going. And I always love this little saying, this reality check, is that revenue is vanity, profit is sanity, and to Trevor's point, cash flow is reality. So you can have a solid top line, you can even be making a bit of profit, but unless your cash flow is steady, and I think to the next point, unless your timing's right, it really can become a bit of an issue for you as a business owner and for your business. So, I guess the crux of cash flow is really that timing point. So Trevor overcommitted and thought he's buying the right stuff, and he'll buy a lot of it and it'll sell like hotcakes, but it took him a long time to sell it. And that's where the timing issue comes in. So as a business, you need to incur cost, but if you're incurring cost, you also need to be able to get money back as quickly as possible to then turn that cash over. And that's really the crux of what cash flow and cash flow management is all about. People also often think that you can actually just outgrow, or I guess outsell, a cash flow problem. And in fact, that's not the case. Growth can actually often create a cash flow problem. Typically, the faster you grow as a business, the more financing you need. So that's something to consider as well. So we think about cash flow and how to solve it in three ways. The first being perspective. So I think a lot of people on this call range from being accountants to business advisors, business brokers. There are even some business owners on this call. So you've all got different experiences. But as an accountant or a business advisor, you're very well placed to help a business owner to provide perspective on their business, but also on their cash flow and their planning and how they should go about it. So we'll touch on that. Measurement's always important. So if you can't measure something, it's very hard to manage it. And then finally, solutions. So as a business, Lululemon, we've got some existing products in market that are very effective at helping solve a cash flow problem. We've recently launched a third product, which also solves a cash flow problem, but it solves it in quite a unique way, which I think you'll be interested in hearing about. And then finally, we're actually about to launch a fourth product, which which actually is not a funding solution. It's really a cash flow management solution. So it will help you understand your cash flow better, track it better, and also forecast better. So it'll put you in a better position to make cash flow decisions. Okay, so perspective, what do we mean? So I think as an accountant and as a business advisor, if you look at the process of compiling management or financial accounts, you're really looking at the numbers, but you're looking at how businesses have performed in the past, and you're compiling those accounts. Really, with forecasting, you need to be doing the opposite. You need to be looking forward and trying to understand what the business needs in the future. And what that takes as an accountant or a business advisor, you need to spend a lot of time with the business owner and asking them questions like, where's your business now? Where's it going in the short, medium, and long term? And also, what does that mean? So what's the plan? Are you going to stay on the current path? Are you planning to expand the business? Do you want to open another branch? Do you want to launch new products? Do you anticipate bringing on some new, bigger customers? Will you need to incur more costs related to buying more product or raw materials? So all of those inputs and decisions will all impact your cash flow, and importantly, the timing of your cash flow. So at what point will you incur those costs and need to be ready for these changes to your business, and then getting the timing right on that. And as I'm sure you all well know, forecasting is tricky. It's difficult. Inherently, it's never that accurate. It should always be used as a guide. I think if you can forecast accurately, then bank funding is a consideration, but you need time to do that. But if your forecast is not accurate, which often it isn't, short-term funding can make a lot more sense. But we'll get into more detail around that as we proceed in the presentation. Right, so measurement. I've included a few sort of key metrics here and ratios. I won't go into too much detail, but these are just a handful of measures that you can apply to your business to really keep track of your cash flow. A common one, which I'm sure a lot of you are aware of, a cash conversion cycle. So this really is how quickly you can convert your cash from spending it to getting it back from a customer. So that you want that to be as short as possible. So to work that out, it's number of inventory days plus your days sales outstanding. So that would be money that's owed to you minus the days payable, so the money you need to pay. So like I said, cash conversion is really how quick can you reduce the number of days between you incurring costs to buy inventory and then getting that money back from your customers. That's very important. Your sustainable growth rate is understanding how quickly your business can grow without needing to incur additional or take on additional capital, be it either through equity or debt funding. And really the equation there is around understanding, if we look at your return on equity, so that's a relationship between your assets and your liabilities, assets being accounts receivable, liabilities being accounts payable. So it's understanding those. And then your dividend ratio. So that's how much money you're actually retaining in your business. So your ability to retain your income and invest that, or rather reinvest it in your business. So that's important. And then finally, the quick ratio. So that's really just understanding how much short-term cash you have in hand to cover your liabilities. So that could be cash or short-term investments or anything you can liquidate to cover your liabilities. And you want a ratio between 1.2 and 2 to really cover those outstandings. I think for the accountants, this is kind of you really live and breathe this stuff. I think for business owners, or just getting a bit more practical, you can really just break it down to three things, which I've highlighted at the bottom. Collection days, so how long it takes you to collect on your invoices. So I think during COVID, it's obviously been hard for a lot of businesses, and before businesses might have provided payment terms to customers, but we're finding now that a lot of customers are having to demand cash on delivery. So it's quite hard for them to provide terms because they just don't have the cash flow. So that's an important one to keep an eye on. If you are able to provide terms, just keeping a very tight control on that. Inventory days, so how long, to Trevor's point, how much cash you have tied up in your inventory and how quickly you can turn that inventory over. You want that to be as short as possible. And then payment days, so that's how much you can, or rather how much sort of breathing room you can get from your suppliers in terms of paying them. So if you can get a bit more breathing room, that always helps. But that really speaks to that, the timing around your ability to, or rather incur costs, turn over your inventory, and then also pay your suppliers. Trevor, these in practice, would you say those bottom three are most important? I mean, in terms of these three ratios, which would you say are probably the most important to focus on?
Cool. Yeah, thanks. I suppose, one thing that's incredibly important is that every industry is different. So, a construction company and how they think about ratios and how they think about cash flow is very different to how a restaurant, for instance, thinks about cash flow, where, your cash flow cycles are a whole lot quicker. You're able to sell your products and achieve liquidity through the inventory pretty quickly, versus a construction company where, you're only getting paid 30, 60 days later, whatever terms you have agreed. So it's different per industry, but the one we typically go to, or the one we are particularly interested in from our side as a business, is the quick ratio. So your current assets to current liabilities. So because Lula Lend or other alternative lenders don't take security, what gives ourselves comfort is the fact that if a company had to liquidate their current assets, stock, that they'd have cash on hand, they'd be able to liquidate their debtors in 30, 60 days potentially. Would that be able to cover their current liabilities and what they're owing at that point in time? If that ratio, as David mentioned, 1.2 or 2 to 1, there and thereabouts, that provides a lot of comfort. And I mean, to any business owner, if you're in that position, you're comforted by the fact that if something had to go wrong, if a COVID event had to take place, you would be okay, and you'd be able to potentially get through, minimally scathed, versus the instance where you have current liabilities exceeding your current assets, and now you've got suppliers calling on payment and that sort of thing, and you're stuck in a rock and a hard place because you're not able to liquidate your stock and get that necessary revenue. So quick ratios is always super important to us. And then per industry, it's, measuring cash conversion cycles and that sort of thing to get a better understanding. For me, another one that's I sort of developed over time, and again, every business is different, and every business is in a different life cycle in terms of how they need to be thinking about cash. But really, an important metric that we look at is, if my business had to stop today, how much cash would I need on hand to cover OPEX for the next at least 3 months? And then sort of build that up over time, so that you're always in a position where, if in an unlikely event of a COVID, or if you've got one big customer that's delayed payment, or something has gone wrong with them where you're unable to collect from them, you're still going to be okay and be able to trade as a business. It's not going to put pressure on your daily operations to be able to continue to go forward. So those are the ratios we think about, and probably the ones closest to my heart, at least.
Perfect, thanks. Right, so I guess looking more at solutions now, and starting with some business tactics. These all, I think, relate to what we've been discussing so far. But just to get practical, starting off, if you're going to sell to a customer, you want to know that they can pay, and particularly if you're planning an offer that customer any form of payment terms, you need to think about the fact that can your cash flow actually support providing them with credit, because that then also adds credit risk to your business as well. Do you actually want to put yourself in a position where you've got a number of different customers that owe you money over 30, 60, or even 90 days? So that's something to consider, understanding your customers. Or would you rather work with someone who could help you understand your customer, or maybe even take over their credit risk? That's something to consider. Then, as part of that, if you are going to offer your customers terms, you want to make sure that you have a solid collection process. It's great that you might be very good at building a unique product, but unless you can actually collect the money on whatever you're doing, it's going to make it very hard to run a successful business. Simple things, clear. You want very clear payment terms in your contracts, and be very upfront about that. A topic we've mentioned already: optimizing your stock cycles, and the story Trevor told. Don't tie up your cash unnecessarily. You want to watch costs like a hawk. You really do want to understand what your costs are all the time, and work with your creditors. Push for payment terms if you can, particularly with creditors who you've had a long history with. An interesting one is B2B sales. So working with particularly bigger companies, other businesses, can be quite lucrative, but something to consider is that often they can push quite onerous terms onto you. So you might work with a big retailer, but often they'll only pay you in, if you're lucky, 30 days, but often it's 60 or 90 days. So it's understanding that up front. It might be quite exciting that you can now distribute through a big Pick and Pay or Checkers, but typically they're going to make you wait for your money. So planning for that and understanding that. And then finally, it's good to be proactive, and understanding through your forecasting and your planning what your capital needs might be, and apply for funding when you don't need it. Because there are some products, so we've got a product which we call our credit facility, which you can apply for and effectively only use it when you need it. So it'll sit there, it won't cost you anything. And when you need it, you can draw down on it, use the money, pay it back. And as soon as you pay it back, that's it, you don't pay any more costs. So it's a fantastic product from a planning, sort of anticipating a rainy day or a few curveballs. You've just got it waiting in the wings, doesn't cost you anything. And then when you need it, you can then tap into it. But I guess the point is be proactive, apply for funding when you don't need it. Because typically when you do need it, maybe your trading's already taken a turn and your cash flow is not looking that great. So you might not get as much funding as you actually need. So be proactive where you can. Right, so going into a bit more detail about solutions and understanding funding. So this is an important context when thinking about funding. So we always refer to the funding sort of trade-off triangle. So there are 3 points: speed, cost, and flexibility. So if you can forecast accurately and you've got the necessary collateral, you can consider going to a bank, but then you need to consider that it will be slow. It can take weeks or months. They often do require an asset or some form of collateral, and they're typically also quite inflexible. So there might be fixed terms, clawbacks. They might want you to commit for 5 years. There might be exit clauses. So looking at that triangle, there's always the trade-off. So it won't be speedy. It'll be pretty slow. It definitely won't be flexible, but you might score on the cost corner, as in it will be a bit more competitive from a cost perspective. But then looking at if your forecasts aren't that accurate and suddenly you do need short-term funding, it's definitely worth considering alternative providers like Lululand, because the funding will be very fast. You can receive it same day. It's also very flexible. So that product I mentioned where you only pay for when you use it and it doesn't cost you anything while it's sitting there, that's very flexible, but you will pay a slight premium. So there's always that trade-off, and that's something to consider when looking at funding. Now, just to give you some insight into how to think about actually applying for funding. So within the context of our products, just quickly touching on minimum requirements and terms. So as a minimum requirement, we need businesses that have been trading for at least a year and have a turnover of at least 500,000 Rand per year, and they have to be based in South Africa. It's important that you're always matching your term to what you're trying to fund. There's no point in taking short-term unsecured funding to, for example, finance a vehicle. That just doesn't make sense. So always make sure that your terms match up with what you're trying to fund. And then things to consider. So I mentioned being proactive. So in terms of running a good business and planning for your cash flow, we look at things like expense ratios. So we look at sort of balances within accounts and your ability to finance debt. And we also look at debt levels within the business and the business's ability to fund any debt. We're very focused on responsible lending. We don't want to over-indebt businesses. We want businesses to grow and use our funding in a positive way. We don't want to cripple them and make it even harder for a business. Your bank statements are obviously very important. So it's good to show consistent turnover. We also look out for sort of inter- and intra-company payments, as well as concentration risk. So if we can see that a company is generating most of their income from only a handful of companies, that could be a bit of a risk, but it can be comforting or it's also advisable that if you do have quite high concentration risk, like lock those customers in with some solid contracts, because that can also help you from a business risk perspective, but it also gives the funder some comfort. With small businesses, personal credit scores also play quite a large role. So always have that in mind. Try and keep your personal credit score as healthy as possible. The typical things that funders look at are judgments, arrears, long-standing accounts. What's interesting about long-standing accounts, a creditor will look at what long-standing accounts are in place and the sort of repayment history. And a tip there is, if you do have a long-standing account, you don't need it anymore, don't actually close it down, just leave it dormant. Because if you close it down, that can actually work against you. So that's something to consider. Trevor, I mean, would you add anything to this list? Anything else to consider at a high level in terms of preparing your business for a funding application?
Yeah, I think before even going and talking to the previous slide, before applying for funding, and this is what we see a lot of the time, is that businesses just go in blindly, that they want access to funding. Whoever's going to give me funding, I'm going to make an application. I'm going to go to my bank, whatever sort of means or tools are available to me, I'm going to use them. But I think just taking that step back and understanding exactly and putting out what sort of funding I need to access for my business. So David gave an example of a motor vehicle being funded, and there'd be two scenarios to that. If it's a new motor vehicle for your business, most definitely go to a bank. Get them to finance it over 5 years, whatever term makes sense to your business, or that the bank's willing to approve for. And that's definitely the type of asset or thinking when you want to take on bank funding. Converse on that, if there's a second-hand vehicle that's available in the market, you're going to struggle to raise funding. You need it for your business. It's going to be able to generate top-line growth for you. Then actually looking at a Lululemon type partner might make sense in that scenario. But what I'm trying to say is really get to the fundamentals of what you need funding for and what you anticipate to do from that. And a big area where we see is at least applications coming through is from companies that are sort of too early stage, or that they haven't been able to generate cash flow yet, and expecting that they would be able to take on debt funding, which 99% of the time won't be the case. That sort of risk for a business that hasn't started generating any cash flow, you would need to be looking at equity type funding there, family, friends, whatever means possible, but someone who would have to partner with you more on an equity level than a debt level. Really, us debt funders, we want to know that there is some sort of cash flow revenue generation going through the business before you're able to access funding through ourselves. And then, just touching on, the reasons and, once you've understood, right, I need access to short-term funding, be it for inventory purchasing, renovations to a branch or whatever I'm looking to open, or whether it be marketing, paying salaries because you need to bridge some funding, waiting for a customer to come. Once you've understood that, and the effect of what that cost is going to be to you to take on that funding, that's when it really makes sense for a partner like ourselves to come on board and see how you can leverage us. And David spoke about a credit facility type product. And that's really where it makes a lot of sense, where business owners need that comfort that if they do need access to cash for whatever reason, they are able to tap into it. But at the same time, if they don't need access to cash at any point in time, they don't have to incur any cost, and they can utilize business cash flow to fund those items.
Perfect, thanks. Right, so I mentioned a couple of products that we have in market at the moment. So these products also suit different circumstances. So exactly what Trevor was saying around, understand, get to the fundamental of the problem you're trying to solve. Is it a second-hand vehicle? Is it a new branch? And what's the timing on that? So starting on the left, we've got our term advance, which is really our core product. So that's if you have a once-off requirement and you need funding, short-term funding. This is all unsecured. It ranges from 20,000 Rand up to 2 million Rand, and it's from 3 months to 12 months. And importantly, there are no early settlement penalties. So if you apply for funding and you put it to work, you buy some stock, and you're able to get your money back on those goods sold, then you can pay the advance back whenever you want, and all those costs are then waived. There's no additional charges, which is very important. It puts the business owner in control. It gives them comfort. It's very much up to them when how they want to use the funds. And importantly, just one needs to make sure that your margins and your ability to turn over that cash can can support the cost of the capital. And secondly, the credit facility. So like I mentioned, this is a fantastic product in that you can apply for it and you don't need to use it immediately. You can use it whenever you want. The core features are like the term advance, but you can draw down and pay it back whenever you need it, and it doesn't cost you anything in between. So I mentioned a product that we launched it was about 6 months ago, and this solves a very particular or specific cash flow problem related to B2B invoices. So as a business owner, if you are doing business with other businesses and you currently don't offer terms to your customers, or you would like to, or maybe you do run a debtors book that you manage, but that presents quite a bit of credit risk to you, LulaPay product allows you to effectively offer LulaPay to your customers. So we'd effectively take over either the debtors book or the funding terms to your customers. So you would add the LulaPay pay option to an invoice, or you would offer it to your debtors book. And what would then happen is the customers, your buyers would then apply for LulaPay, and if they're approved, we could then settle your invoices immediately, while at the same time offering your business customers 30-day free terms, or the option of extending those up to 90 days initially. And we're actually releasing a new version of the product where that can be exceeded to 6 months. And what's exciting about that as well is we actually also iterating the product where we'll actually add, or we're offering a credit facility version of the LulaPay product. So what that'll allow you to do is actually pre-screen your customers. So if you have a new customer and you're not sure about their ability to pay you, you could offer them LulaPay. We could offer them the LulaPay credit facility and effectively pre-screen them. And if they are then approved, they would have a LulaPay limit, which they could then draw down on. And effectively, you would know that their limit is, say, for example, R1 million. You would know that they would be good for R1 million worth of invoices that could be paid. So you could issue invoices to them and you'll be paid immediately. And they would then could choose to either take the 30-day free terms or pay it back over a longer time. So the beauty of that is that you as a business owner is that you have no credit risk and you don't have the mission of following up on payments, because you know that your invoices will be settled immediately, while at the same time, your customers will have the comfort of either getting 30 days of free terms, or they can look to extend it if their cash flow needs a bit of a breather. So that's a product we're really excited about. And if you have any more questions about that, just you're welcome to email us and we can provide you with more information. And then I mentioned our fourth product, LulaFlow. So LulaFlow really is a product we're looking to launch this month. And this is not a sort of direct funding solution. What it is it's a financial management tool to allow you to analyze and understand your cash flow a bit better. So what you would do is you can link your bank account or your your cloud accounting software, and that data will get pulled into LulaFlow, and it will allow you to analyze exactly what your cash flow looks like. But effectively, it'll give you an idea. If you look at this middle image where it's visualizing performance, it gives you a look at your balance, it gives you a look at what's incoming, what's outgoing, what your net cash position is. It gives you a graphical representation of that information, as well as a calendar view, so you can see exactly when money's coming in, when money's going out, when is it due, what your overall cash position is. You can drill down into any of these metrics as well to understand what's driving them. So if money's coming in, where's that money coming from? The same with money going out, as well as your cash flow position. So this is a great tool to offer customers. So if you're an accountant or a business advisor, you can offer or refer them to us and offer them LulaFlow, and that will just put them in a much stronger position to understand and really get on top of their cash flow, but also help with forecasting and anticipate when they might potentially need capital in the future. And the beauty of this, I mean, I think most small business owners run their cash flow in a spreadsheet, and that in itself is can be a full-time job. So we're very excited about this product and its ability to really help businesses get on top of their cash flow and put them in a better position. Trevor, do you have any additional thoughts about our current products and the problems they're solving, as well as LulaFlow?
Yes, I mean, we're obviously super excited about LulaFlow that David's spoken to, and with a few accountants who are potentially on the call here. Really what we have found is, as accountants and at least businesses that make use of accountants, generally what we're seeing is the relationship between an accountant and a business isn't as fluid as, definitely not on a weekly basis, but maybe monthly, every quarter only, where businesses are interacting with their accountants. And then it is obviously more focused on more traditional metrics on what your P&L is looking like, what your balance sheet is looking like, and that sort of thing, and not really getting to the nuts and bolts of cash flow on the business and how the business owner should be thinking about their cash flow position and where they are at that point in time. So really this tool is, as we believe, as an aid to any business owner to be able to provide real clear guidance on their cash flow, what they can expect coming in, going out. At the same time, the purpose of the tool is to understand, will I actually need access to funding at some point in time? And then making the necessary provisions to make sure you can access funding when you need it. So we're excited there. We believe it can work pretty well hand in hand with accountants. And then for your smaller businesses where, maybe accountants aren't utilized, or maybe only once every year for annual submissions or whatever the case may be is, then we feel it will be a fundamental tool for businesses to be able to run their, or at least have insight into their accounts without spending hours in Excel where, to be honest, a lot of business owners potentially don't have the financial abilities to understand exactly or get a clear picture on exactly how the business is looking. So excited on this particular tool. David's spoken to LulaPay, which is new and obviously more focused on the B2B space. And then the term loan and credit facility we've had those around the market for the last 5 years or so, and still very optimistic on the potential. And we believe, a lot of, we've spoken about the differentiation a bit earlier between banking funding and accessing alternative funding, but a lot of business owners can use it hand in hand, and that's also what we've seen. So, utilizing bank credit for some areas of the business, but then always having access to the short-term cash flow, working capital focused cash flow, which never goes away. Maybe when you're a 200-300 million rand revenue business, there's other protocols in place that you do away with this. But what we've seen from our experience is that most businesses out there need a consistent working capital solution that's live and available to them, which again speaks to the credit facility product out in market. But it's a business owner understanding on how to marry the right funding options into their business at any point in time.
Perfect, thanks. So as soon as the LulaFlow product is live, we'll let all of you know. So we've had a question in the chat box. The first one was asked how they can subscribe. So that actually leads nicely into our next slide. So as an accountant or business advisor or business broker or anyone who has a relationship with a business, even a business owner, if you know other businesses, you can sign up to be a LulaLend affiliate. And what that means is that if you know a business that might have a funding need, maybe you work with them quite closely and know that they'll need some working capital in the future. And I think importantly, now that you have a better understanding as to how alternative funding works and how our funding works and how it needs to match the particular requirement, if you feel that they do meet this criteria, then you can actually refer them to us as a LulaLend affiliate, and you can even earn commission on that, which is great for you, but then it's also great for the business that you refer, because obviously they're then receiving funding. So if you want to do that, you can just go to our website, and at the bottom of the site there's a link for affiliates, and you can sign up and register. Talon Shrimpton is our affiliate manager, so he's always on hand to assist you if you have any questions. Maybe you have a few more in-depth questions as to what we covered today, but he can assist you with any of that. And that concludes our webinar for this afternoon. Thanks again, everyone, for attending. I see there is one more question in the chat room. Let me quickly look at that. What is the cost of LulaFlow? At this point, that's still being figured out. I think for existing customers, we are considering offering it just as part of our service. There won't be a charge, but we're still figuring out for new customers who aren't existing customers. That's still to be defined, but we will share that as soon as we have figured that out. There's another question: are you able to fund a business that is busy with turnaround and recovery implementation? Trevor, do you want to maybe take that one?
Yeah, look, it will depend on the metrics. So, you know, every business is unique. Every application that comes through our system is assessed uniquely. Having said that, our system is programmed with our algorithms to take into account certain areas of the business to understand performance and score against that. So it really depends in this instance, you know, what sort of position is the business coming around from? If they're in a fair bit of trouble, again, it's hard to make that call without actually seeing the numbers behind it. But, you know, to be honest, from the COVID period last year, a lot of businesses were coming from a turnaround position that we were supporting and getting through the COVID period, but really getting a lot of them back on their feet to help them succeed, you know, sort of post hard restrictive lockdowns, and giving them the ability to scale up again. So it is very business specific, I suppose it was what I'm trying to say in short, but it is definitely something that we have funded in the past and continue to fund going forward. Fantastic.
We've got another question around our costs. Like I mentioned, there is that trade-off. So if you want speed and flexibility, you will pay a slight premium. So you can expect to pay more than what you would pay at a bank. But saying that, if you have a bank overdraft, you know, their fees can match or even exceed some of our fees. So you always need to make sure that you're comparing apples with apples and that you're comparing sort of like for like when it comes to funding. We've got a cost calculator on our website, so you can also go and have a look there to just to get a feel for what the costs are. But just to give you an idea, it also depends on risk. So we apply risk-based pricing. So the higher the risk, we do charge a little bit more. The lower the risk, we will charge less. And then also typically once a customer returns for more funding, we do look to reduce the cost as we understand their business a bit better. But typically, for example, over a 6-month period, you can expect to pay approximately 17%. Importantly, we don't charge an interest rate. We charge a fee, a cost. That's a cost of the capital, and we're also very clear and very upfront as to what those costs are. So when you apply for funding, we'll provide you with a table as to what those commitments are every month. Sometimes it will be you might pay more than once a month, and then you might pay twice a month. But it's very clear as to what those are and what that expectation is. And like I said, if you only, let's say, for example, it's a 6-month term, and like I said, it will be 17%. But if you only use the funding for, say, for example, 2 months or 3 months, and you pay back, all future costs are then waived, so you won't pay the full amount. So it's very flexible, and as the borrower, you would be in complete control. Another question from Siyabonga. Does Lula help out construction companies, equipment suppliers, loans? Because I want to supply equipment for fire because it's constantly needed. Absolutely. So we do. The construction industry is one of the bigger sectors we actually fund. If you look at an industry breakdown of our book, so we do look at companies who work in the construction sector, and if one's providing equipment, and like we mentioned in the presentation, if a company has the cash flow to support the debt funding, then yeah, we can absolutely look at supporting that business. Great. I don't think there are any more questions. Thank you once again for attending this webinar. Trevor, thanks so much for your time and insights. Yeah, we'll chat soon. Thanks, everyone.
Thanks, David. Thank you, everyone.